Welcome to the Intelligent Investment Show. I'm Garrett Lill here with Matt Dahl of ARPG. It's been a pretty quiet little season for the market here lately. I mean, I'm looking at the charts here. Wednesday on the chart looks like, oh, we had a little dip there, but it was only like 0.5%. Markets have been very quiet to start the year. We're just steadily kind of plugging along. What's going on in the week since we last spoke, and what's been the catalyst for any movement, and what's the catalyst for the lack of movement in the market right now?
Well, let me start on the other end. Let's skin the cat from the backside today. The catalyst for kind of the lack of movement is, we have earnings season again, right? The market's up about 1.2% year to date as we sit here right now. It's called 69.45. We started the year, we finished last year at 68.45, so we're about 100 S&P points. So maybe 1.3, 1.4% for the year. Nothing crazy. Most of that was the first week. In fact, we kind of want to look at the 5 separate markets. The S&P over the last week is up 0.33%. That's it, 1/3%. But the equal weight is up 1.6. It's 5x the cap weighted for the week. Okay.
Wow.
And that just lets you know that broadening trade, that breadth is really starting to widen out and really starting to take hold this year. So we're seeing that. I don't think that's going to last forever. I think we'll get into that in a minute or so. The Dow, same 0.36 for the week. NASDAQ, 0.21. So everything's been just kind of muted this week. The outperformer in the story of the week is the small caps, 2.8% this week, 2.8%. And I think that's in large part due to your regional banks, because your regional banks make up 40% of small caps. Okay. And that has to do with mortgage bonds. Okay. Trump announced exactly 1 week ago that he directed a purchase of $200 billion in mortgage bonds to get mortgage rates down. Okay. And if you look at the 10-year on the last week, it's flat. It was 4.17 a week ago. It's 4.17, 4.18 today. Okay. However, mortgage rates are down 15, 20 basis points. Okay. There was a 40% increase week over week in refis. Okay. Some banks are now issuing sub 6% 30-year fixed mortgages. Okay. So what you saw was the regional banks just really explode. And that's where you're seeing these, the potential for lower rates, the potential for lower mortgage rates. Those are really good for your small caps, specifically as it relates to regional banks. So, and you can see sort of the Mag 7 trade has really been put to the back burner. Okay. That's why we have the NASDAQ again as the underperformer for the week. But I don't think that's going to last long. I think we're going to go from the Mag 7 to the Fabulous 5 or maybe the Fabulous 4 this year. Okay. And of course, we like Google. We think Meta is a great buy. I think, NVIDIA is just a juggernaut rocket ship. It's, I think I'm going to get the little NVIDIA swirly thing tattooed on my chest here pretty soon. Tesla, that's a funky one, but it's very expensive for a car company. But when you get the robo-taxi involved and you start getting now they're getting these home robots and all of the other technology, and of course SpaceX and their technology that they can lease out, I think they're going to have a pretty stellar year. And also Amazon. Amazon, I think, is going to, they didn't really have a great year last year. We're seeing that consumer come back. We're seeing it come back, pretty strong. I think there was a lot of issues priced in with Amazon last year as it relates to the tariff that would get into their margin. Of course, that never showed up. And we're starting to see, in fact, the ICR conference was this week, which is the International Consumer Retailer Federation, right? And the holiday spending was very, very strong. It actually beat consensus, and they're looking at those tailwinds coming from the fiscal stimulus, i.e. the tax cuts this year, okay, are going to be a huge tailwind to your consumer spending, to your retail, which we think is going to be very good for Amazon. So we're calling it the Fabulous 5 this year, right? Basically, Google, Meta, NVIDIA, Tesla, and Amazon. We think are going to be really good. The other group that's going to do really, really well, we have the mortgage side. The regional banks are going to do well. What's the other side of that? What are they going to be doing, right? They'd be buying homes. Okay. Home builders in the last week, since that mortgage purchase was announced, they're up 8% if you look at it through the ITB. Okay. The home builder ETF. So we think there's a lot of tailwinds as it relates to just kind of your middle consumer strength going into this year. We don't think it's going to be a Mag 7 story this year. We think it's going to be a small cap, broadening, and Fabulous 5, but that's going to be back-ended for the year. And there's going to be some volatility because remember, we've got on the 4-year cycle, if you cut each year into halves, So you have 8 halves of a 4-year presidential cycle. The first half of a midterm year, which we are in right now, is the worst and the most volatile of all 8. Okay.
Yeah.
So we expect this half of year to be somewhat volatile, but probably less than it is most of on these cycles, on these 8 cycles. It'll probably be more volatile than most half years, but probably not more volatile than other similar times, because we had a lot of volatility last year. But if you like JP Morgan, there's a lot of tailwinds. I mean, there's a lot of energy going into the market right now. JP Morgan had the largest inflows into their equities last week that they've had since the April lows. Okay. So there's just a tremendous amount of retail buying right now. Of course, we have the Iran situation we're dealing with. Of course, we have the Venezuelan thing we're dealing with. Of course, now we have the Greenland thing we're dealing with. So we have these sort of just this amazing investment landscape and environment. Lowering rates, it couldn't be better, with the exception of we're not sure what's going to happen tomorrow. We have this huge ball of uncertainty. So, as long as earnings can do what they do, we're not going to get any multiple expansion this year. What we're going to get this year is earnings growth. This is going to be one of those years where the earnings outperform the market, which means we're going to get multiple contraction this year, which frankly we need. 22 and a half, 23 times. That's just nosebleed territory. I would like it, because if we ever start, if these earnings consensus and this guidance starts to come the other way, well, now we're going to be, like we talked about before, we're going to be multiplying that number by a smaller earnings number. Well, the problem is that multiple is going to go the other way in a hurry. So if right now, if we're looking at end of 2027 earnings of $3.50 a share, you multiply that by 22 times earnings, you're looking at what, 7,350. So, or 77, I'm sorry, 7,700. So if we have a situation where it goes to 330 a share, okay, well, that moves the multiple from 22 down to 20, which is still pretty good. Now you're at 6,600. Now we have a negative year. So so the earnings really have to do their job this year. If they don't, we'll actually get a little bit of multiple contraction, which would cause kind of a negative year.
Yeah. Well, thanks as always for your time, Matt, and for investors and listeners, viewers. The Intelligent Investment Show is for entertainment and education purposes only. Disclosures coming your way here very soon, but all that basically means don't take our word for it. But if you do have questions and would like to speak with Matt or someone on his team about your specific financial situation and get some of his guidance, you can reach him at 702-655-8300 or visit intelligentinvestment.com to learn more about ARPG and how to get in touch with Matt and his gurus over there. Matt, always a pleasure, brother. I hope you have a great weekend. See you next week, and thanks again.
See you next week.
See ya.
Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group, ARPG and United Planners are independent companies. Garrett Lill and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risk, and there is no guarantee of any future results, performance, or success.